Well, with the growth in economy as well as rise in interest rates, it's not just equity that throws an investment opportunity, but debt looks an attractive asset class too. And both of these asset classes together play a vital role in the wealth creation experience by investors. So, the session is about debt asset class from the lens of alternative investment funds. Ladies and gentlemen, please welcome the panelists and moderator of this panel discussion, where they will address the topic expansion in Indian private capex, an opportunity for private credit funds. And our panelists are Mr. Karthik Athreya. He is the director and head of strategy for alternative credit at Sundaram Alternates. He is a financial services professional with over 22 years of experience across principal investing, funds management, investment banking, corporate finance, assurance, and transaction diligence services. He heads Sundaram Alternates private credit team, which manages assets over $170 million across real estate and private credit. Our next panelist is Mr. Hemant Daga. He is the CEO and founder of Neo Asset Management. He has more than 19 years of experience in Indian financial services across leading organizations like ICICI Bank and Edelweiss Financial Services. In his last role with Edelweiss, he was the CEO of the asset management business, which went on to become one of India's largest platforms with more than 30,000 crores of alternative assets and 75,000 crores of mutual fund assets with marquee global and domestic clients as partners. Our next panelist is Mr. Ashish Khandelia. He's the founder of Certus Capital and Earnest.me. He has over 20 years of experience with expertise in real estate investing and lending. In his earlier roles, he led real estate businesses at KKR and Morgan Stanley Real Estate in India. He has over US 2 billion of transaction experience and has been instrumental in building 3 businesses around real estate banking, equity investing, and lending. The moderator for this session is Ms. Aparajita Sharma, a financial journalist and certified financial planner. Aparajita has a decade-long experience in covering the equity market and personal finance beats. She has extensively written on stock market trends, mutual funds, startups, and financial planning, among others. She now freelances for Mint, Fortune India, Outlook Money, and Singapore's Business Times. She's also a video host. Over to you, Ms. Sharma.
Hi. So thank you so much. Thank you so much for a warm introduction, and really happy and honored to be part of this wonderful session. And now I won't take much time. It's the last session. So now I welcome Mr. Karthik, Mr. Hemant, Mr. Ashish to last session of the day. But before I begin, I would like to thank you all viewers, all participants that have stayed through the day to attend this session, and that too on a Friday evening. So not taking much time, I'll quickly introduce you the topic. So as you must be aware that Indian government of India has announced highest CapEx for second year in a row. So this year for FY24, they have announced 10 lakh crore, and last year for FY23, they had announced 7.5 lakh crore. And after government CapEx, it's natural cycle that private CapEx will boost. But for private capex to boost, we need capital, we need credit in economy. And how do we do that? And earlier in the day, if you had attended Mr. Vikas Sachdeva's session, then he had pointed out that if India were to become a $5 trillion economy, then we need credit of about $2 to $2.5 trillion. And how do we do that? Banks and NBFCs are not capable enough to do that. They avoid high risk credit. And if we talk about mutual fund companies, then they have also been avoiding this high risk credit after Franklin fiasco. So what do we do? So here lies the opportunity for private credit funds. Now, I assume that this audience would understand what private credit funds are, but if I were to explain it briefly, so these are investment vehicles for HNIs, where fund managers pool money from HNIs, and then this money goes to private companies to help them boost their business as a loan. Now, my first question will go to Karthik. He recently closed a private credit fund. So, Karthik, over to you. If you can explain what sort of demand did you receive in this fund, and what are your takeaways about? Karthik, you are on mute, I believe.
So, thank you to PMS AIF World for this opportunity, and thanks, Aprajita, for introducing the opportunity. Highly relevant today. So the answer to your question is there is tremendous demand and there is an explosion of private credit. And we are in the process of raising, by way of private credit, our fourth series and second in product from Sundaram Alternates. Just to give you a sense, over the last 5 years, we've raised close to 1,800 crores, deployed over 2,000 crores across 40 transactions, and generated returns of anywhere between 16 to 18% in the hands of our investors. So this is an asset class that is growing quite substantially. And there is tremendous sort of interest because I would say we'll probably go through it later in the conversation. It is a very viable bridge in terms of risk-adjusted returns between typically what a fixed income investor would get historically or is getting at the moment, and quasi-equity or equity type returns that are either generated out of capital markets or from private equity type investments. So it has emerged as a very viable alternative also from an asset point of view, because as you rightly pointed out, in 2.8 trillion sort of credit market with 1.6 trillion sort of bank debt and another 0.4 trillion of non-bank debt, there is absolutely a shortfall in terms of credit offtake requirements. From a business point of view. So whether it's CapEx related or enterprise related, and we'll talk more about that. So, we are currently, open on our corporate credit theme. And, we did a first close recently, and we hope to do a final close. And, we are very keen and, focused on this business in terms of wanting to raise multiple funds in this space.
All right. Now, Hemant, if you would like to add upon something, what about you at your firm?
Thanks, Aparajita. Thanks, PMS AIF World. I think very pleased to be part of this virtual session. So as Karthik said, I think the demand for private credit, I think this is a large structural opportunity we see emerging in India for the next several decades. And the team at Neo, we've been involved in this business in our earlier professional lives for the last 10 years. And I must say that in the last 6 years, we are only seeing this strategy grow. There are several funds in this space. In India, the opportunity is very large. It's a 50,000 crore annual opportunity as per Ernst & Young, which will become a 1.5 lakh crore opportunity in the next 4 to 5 years. That's probably, Aparajita, as large as the size of our IPO markets in India. And I must also add, I think this is not an opportunity which is unique to India. This has been in the developed markets like US for several decades, and Ashish can add to that with his global experience. Funds like Oaktree, Harvard Marks of Oaktree, Blackstone, these are some of the world's largest private credit funds, and which is why we at Neo are very bullish on this space. It offers very sweet risk-adjusted returns to clients. It gives them regular cash flows, and at the same time, safety with EBITDA of companies with collateral covers. So you have asset values and cash flows which help protect customers. As Karthik said, I think Indian investors are just warming up to this opportunity over the last 2-3 years. More and more investors are participating. We at Neo have also been, we launched our first fund, and I think the heartwarming response that customers have given us, in 6 months' time, we've raised approximately 900 crores. And I think customers are liking this space. They understand this space. They want to participate in this opportunity. And I'm sure over the next several years, more and more customers will get educated, informed about this. And we will see more interest from Indians, I think, domestic investors, just as people participate in equity markets, people would participate in these strategies also.
All right. Okay. Ashish, do you agree with Hemant? Have you observed the same kind of demand scenario from investors for private credit funds? Or what sort of observations do they talk about?
No, absolutely, Aparajita. I think it's, both Karthik and Hemant have been pretty spot on in terms of what we are seeing in the domestic market. So So just to build on that, very clearly, private credit as an opportunity has been playing out. I mean, even at a global level, yes, it is a more nascent asset class compared to, let's say, private equity. So globally, private equity AUMs now touch almost $4 trillion. On the other hand, let's say private credit AUMs are still about close to just about a trillion. And they were only about close to 300 billion at the starting of this decade. So, so in that sense, it is a much faster growing opportunity. This AUM has more than tripled, right? And it has a long way to go. Generally speaking, debt AUMs are much larger than equity AUMs. So at one level, you are seeing private equity, which is an older asset class, is already at 4 trillion, and private credit is still just about a trillion. So you can see just the long, pace that it has to go. And it's just very structural. I mean, if I were to compare and contrast, I mean, it's really like we talked about, India has to become a 5 trillion economy, and how will we go there? So if I just cut through all the noise as to who will provide and what will provide, I mean, corporate debt to GDP ratio in US is about 123%. In China, it is 36%. India is just about 17. So it's just very small in that sense. Within that also, yes, banks and NBFCs do what they do. But, all our bond markets are only AAA and AA. Honestly, AAA and AA is a very small segment of the market, especially a country like India, where, there is so much focus on SMEs and medium sector enterprises and other sectors which don't get the love from traditional financial institution, including real estate and all that. So, so when you look at all of that, it just is a very compelling opportunity, both in terms of what India needs and in terms of the gap that lies in personal investment portfolios for domestic institutions as well as personal capital. Now, last point, if I were to add to that. So, like these seasoned players like Oaktree, Cerberus, Goldman Sachs, Ares, SSG Asia. I mean, if you would look at it, the moment ILFS happened, which is like in September 2018, which basically for a period of time shut down Indian credit markets. These guys just zoomed in and they had invested. I mean, Apollo alone has invested more than $2 billion in real estate private credit. I mean, Oaktree has done close to $1 billion. So, it's just a testament of the fact that the smart capital, which is already very seasoned on this private credit, they are seeing that big opportunity. So there's no reason why Indian investor should not benefit from the same, right? And it's a testament to what Karthik is saying. We are a relatively newer player in this thing, and I will talk a little bit more about how we are educating the market about this and what we are doing. But I think it's on the horizon, and we can't miss it.
Okay, now come to history of private credit funds. So how they have evolved. So Karthik, if you can explain who were the first movers in this space, and which credit funds have lived their cycle, and what yields did they offer, how much investors earned, all these aspects.
Okay, so just to put this in context, as Ashish and Hemant said, it's a very new asset class that has emerged in the country. Frankly, the AIF industry, where most of the private credit funds operate, itself is a decade or slightly less. So essentially, in terms of institutionalization of private credit, it's a very young industry. So, as both my colleagues alluded to, the future is likely to be much bigger than the past. But having said that, we have close to, I would say, from 10 years ago, if you just were to look at category 2, if I assume our audience knows how AIFs are structured, and there's 3 categories. Category 1, which has a certain set of funds, we can talk about it. Category 2, where most of the credit funds operate, and then category 3, which is essentially reserved for listed sort of strategies. The category 2 itself, just by way of scale, about roughly 10 years ago, it was 100 to 120 million US dollars, based on statistics that are available on SEBI's site. And if I was to look at that number last week, that was close to 30 billion. Just in Cat 2. So if my math is right, that's about 250 times. So essentially, the growth has been so stupendous, and it has far outstripped any other asset class in terms of mutual funds, in any of the other growing asset classes, which is testament to the fact that there is, as both my colleagues said, a very structural shift. Now, if one were to analyze why there is a structural shift, our biggest data point, or at least mine, is the fact that, if you see the ratio of overall, corporate credit in its various forms, roughly, 2 trillion out of the 2.8 trillion of debt, essentially that's 80% bank finance historically, maybe more, if you were to trace back to the mid 90s to early 2000s. If you see and the balance is non-bank sort of sources, largely NBFCs, till the ILFS crisis. If you see the similar statistic in Western markets, so particularly the US, it's exactly the inverse. So there's 20% of the credit markets that is financed by banks, and they largely stick to personal finance, risk-averse type stuff, socialist sort of financing. And all risk capital, essentially, is being financed by non-bank companies in its various forms, whether it's the big funds of the Blackstones and the BlackRocks, or non-banks, or essentially non-bank, non-commercial banks. So, we see that trend largely will replicate in a country like India, where, as the market evolves, as Ashish said, bond markets start to develop, marketplaces are already starting to form. This will be a structural shift where banks will essentially start competing in traditional forms of financing, maybe stick to sectors like infrastructure, project financing, personal financing, and even post ILFS. If you see, NBFCs have largely consolidated into specific strategies, whether it's gold financing, housing finance, microfinance. So you don't find too many general corporate credit NBFCs that are operating in the market. You can actually count them off your fingers. So essentially, all of this points to the need for an alternative source of credit, which is really where a host of private credit funds have mushroomed over the last, let's say, 5 to 6 years. And it is starting to sort of accelerate as we speak. So in terms of individual track record, considering the nascent stage and the young phase of the industry, there isn't a lot of empirical statistics that is out there in the market, but Hemant may actually add some color, because I think, if I'm not mistaken, Edelweiss was one of the first, I think it was called the Credit Alpha Fund or something, which is way back in 2013 or 12. And then there was, I think, a DSP fund in BlackRock fund, that got formed in 2014. But essentially, there are a variety of strategies which we'll talk about later in this conversation, where typically returns tends to range, between 15 to 20, at least from a targeting of returns point of view. And then, of course, it depends on the vintage in which those funds were raised, the philosophy of those managers, the strategies that they were in, and so on, which sort of ultimately determine, what those are. And I think as an asset class, even from an LP or a domestic investor standpoint, we have at least started to see asset allocations move away from almost 100% equity to these kind of alternate asset classes, including private credit funds. So with that, I'll stop and let my colleagues also speak.
Okay, Hemant. Yeah, please share your insights about it. 2013, your Alpha Fund, if you can share some details about it.
So yes, I think in my earlier professional capacity, we were fortunate to be pioneers in this space in India. And in fact, some of the funds that we launched have been some of the most unique strategies in India, whether it's a infrastructure yield strategy or whether it is a special situation strategy. And I must say, Aparajita, the experience in India for funds in alternative space has been very satisfactory. I think funds have seen a difficult credit cycle in the last 7-8 years. I think there have been several events in the Indian economy, whether it's the taper tantrum, it's been demonetization, it's been the COVID crisis, it's been the liquidity crisis. And yet funds have delivered, at least in our experience, close to 16 to 22% returns across a multitude of strategies. So private credit is a broad umbrella. As Karthik was saying, I think within the broad umbrella, are there multiple strategies? There are clearly multiple strategies. There are, simpler corporate lending strategies which can aim to deliver 16 to 17% returns, right? There are maybe real estate credit strategies which can aim to deliver 18 to 20% returns. There are special credit opportunities which we are currently focusing on NEO, which is a very, very regular cash flow throwing strategy, lending to largely EBITDA positive companies with collateral comfort, which can aim to deliver anywhere between 18 to 22% returns. So it's a broad spectrum. Within private credit also, customers have a choice. And I think depending on client needs, client risk appetite, there is a range that is there for customers to, dip into. But the important point is, I think all of this lending is cash flow backed plus collateral supported. And that is the beauty of private credit. Typically I tell investors, in very few investment strategies do you typically have a plan A, plan B automatically built in. We are fortunate to be in the business of credit where your plan A is cash flow and your plan B is collateral. And this asset class combines the best of that in that sense.
Right. All right. Ashish, so now that we have touched upon the points around how do you pick companies, if you can explain, or when you go out and look for opportunities, and how do you do that? And what are some risks that you look at and what investors here should know about?
Sure. So Parajit, I will talk more broadly and then talk a little bit about more, which is my own expertise, and other colleagues can add to it. But basically what we have seen on the corporate credit side, I mean, the very reason corporate credit exists is because it requires a bit more specialized understanding of the situations. I mean, the difference between a typical equity investment and when you're trying to make it out of a private credit investment, the fact is that in equity, you are actually just, generally speaking, betting on the growth, whatever it may be. You may come in very early and then you're trying to bet on a hockey stick growth, which is more the venture capital kind of investing, or you can be a private growth investor where your company is a little bit more mature but still in its growth phase. But you're basically betting broadly on the company growing over a period of time, and that's one key thing, right? Private credit opportunities actually gets created out of a lot of various different things. I mean, to give you a few examples, there is a company which does not want to dilute its capital because it's growing very well, but it has some fantastic acquisition targets. It's a fantastic opportunity for a company to go ahead, take private credit, right? And they will pay off that higher interest for a short period of time, but then they will be able to grow inorganically very quickly, right? There are certain value unlocking events. Certainly, let's say plant is coming on stream, and that plant, once it comes on stream, is going to certainly significantly increase the EBITDA of a certain company, right? Or it may be a situation where the company is looking to sell a certain asset, and when that asset sale happens, there'll be a fair amount of cash flow that will come in. Now, most regular financing and banking channels are unable to appreciate or take these event kind of risks, but people with specialization, they generally understand. They will be able to, in fact, make an assessment, okay, what is the value of that asset that is getting disposed or getting acquired, and create structures around that, right? And that is where I think when Hemant said, generally speaking, any credit investor would really look at both these aspects. Where is the cash going to come from? And then there is cash is what's really going to give you your money back, both interest and principal. And then you really have these collaterals, which if something were to not pan out the way it is there, you're typically sitting on anywhere between 1.7x to 2x to 2.5x of value. And that allows you to really make sure that the company is aligned to pay you back, right? I think those are some of the basic principles that people apply. Like my own area of expertise ends up being real estate. I mean, and when we look at real estate, I think what we are really looking at always is that basically there is a very structural, fundamental requirement, let's say, of housing where a lot of this credit gets invested, right? And again, we have gone through a significant amount of cleanup through DMON, GST, RERA, and all of that stuff. So if you look at it, in fact, over the last 3-4 years since I left KKR, and it was literally the year in which ILF has happened. So we just saw suddenly leaving KKR and this whole Indian credit system freezing up. And that allowed us to be part of almost 8,000 crores of private credit transactions being done by global credit funds, right? And when we looked at that, in fact, we came to a conclusion in 2020 that despite everything and despite the several $billion these guys have put in, the shoe that we are trying to fill is about 40 to 50,000 crores that used to get disbursed every year. And that's gone. And then you are actually at a cycle where the fundamental market. So you talked about private capex in general. I mean, same story we were seeing playing out in real estate. We in fact came up with the December 2020 research paper to say we are at the cusp of a significant improvement in the residential cycle where affordability stands, et cetera, et cetera. So there's no capital. And without domestic capital, nobody can fund for it, right? That was actually a conclusion. Fast forward 2 years. I mean, there's a JP Morgan report in 2023, Jan 2023. It says 1 billion square feet in sight. So they're almost saying that the housing demand and what will get contracted is going to double. So this whole turn has actually happened, listed in all the things, and still the capital remains short. So I mean, here I will just add this one twist that while we are generally talking about how the funds are doing, there's one more very interesting thing that's starting to play out. And again, it is at the intersection of one Indian investor and Indian advisor, financial advisor, or sophisticated wealth houses and financial advisors starting to realize the importance of putting this asset class in their investor portfolios, right? And I mean, some of these examples are very simple. I mean, last year, World MSCI World was down 20%, emerging was down 23%, US was down, or developed market was down like 19%. So across the board, Bitcoin was down 63%, Indian USD was down 11%. So you look at whatever, I mean, everything was down, down, down. But in general, if you had like a structured credit done properly in this way, yes, you have been making 15, 17, 18%, whatever that is, right? And that is actually played out. This last year actually tells you exactly the starkness of this asset class versus some of the other things, right? So I mean, one other thing that we are seeing, talking about that trend, and this is exactly what we experimented with, is one is the fund, but as the market is getting educated, one of the other approach we have taken is actually create these opportunities. So under this earnest.me platform, what we started doing was we actually create these opportunities. We take them on our own balance sheet. Then we say, okay, we will hold 10% of it. And by the way, you have an institutional quality co-invest opportunity available where you can do 90% of that, right? And what it is doing is people who are a little bit new to this, as opposed to committing a very large amount of money or as to committing money to something that they don't fully understand. Though I would always say that funds are the way to go over a period of time, but it's a good mix that you can do. You can allocate some to the fund and you can allocate something to like this. And what it allows you to do, and these things tell you exactly, okay, this is the day on which the interest will come. This is the day on which your principal will come, and so on and so forth, right? So it's almost like a bond platform, but as opposed to it being a marketplace, it's more like a market maker. We create it. We are on one side of the trade, and you can buy it, right? So we have seen some very fantastic response. We have close to 300 investors and almost 50% of them doing repeat business. So that's another thing. So one is the AIF route, which is deepening this opportunity. Other is all this fintech way, which is actually creating a lot of education and deepening this opportunity in a slightly different way.
Okay, Karthik, if you can explain more about risk assessment. So what sort of risk assessment tools do you use? And how do you track the various activities that are happening? And if things go wrong, then how do you spot those? And if you can share some examples, specific examples, and are there specific sectors that you look at all these aspects?
Sure. I'll just add on to what Ashish and Hemant have said, because I think they hit the important fundamental points that, essentially this whole asset class is about making secured investments, which means secured by tangible assets. And then, you're backed by cash flow, right? So aside of that, from an investor point of view, just to get a little basic and simple, we belong to one of the asset classes where, we do very, very simple bank type lending. Although it's structured as AIF category 2 funds, our model simulates exactly what a bank would do. For example, from a risk point of view, all our investments are amortizing, which means, if you write a 4-year tenor, our duration tends to be between 2.5 and 3.5 max, right? So you get money back much, much faster because you're getting principal also repaid every quarter. We also collect interest every quarter, so it's a current income model. So an investor who puts in 1 crore, for example, can expect to receive income every quarter from fees, redemptions, interest, and any other income variety that we make. So there is an active current yield. Typically, these tend to be closed-ended funds. So essentially, an investor would ask, if I'm going to lock up money with you for 4 or 5 years, how do I get compensated for liquidity? Usually, the competing asset classes are listed and open-ended funds. So we distribute income every quarter, which is fairly sizable. And most of our returns on the fund are actually made through the power of compounding. So essentially, as coupons compound, over a bit of time, they generate that IRR. Aside of this, from an investor and even a creditor protection perspective, we would have all the bells and whistles you can imagine in terms of personal guarantees, corporate guarantees, share pledges, financial covenants to make sure that, the business doesn't, do stuff that is not part of a business plan and so on and so forth. I don't want to get too granular here because it's a wide audience, but essentially the idea that I wanted to convey is that an investor is protected structurally by virtue of every investment being backed by assets in cash. They are being protected, from a creditor rights perspective, through a fund manager, because all of us on this table, have done this before. And I've actually done private credit from 2005. So way before time, when I used to run a private equity fund for 10 years, so I've done, 2 billion worth of tough stuff, which is, not just performing credit, but stressed, distressed. So essentially from a enforcement perspective, downside perspective, what works, what doesn't work, which jurisdiction, which forum, can you actually enforce effectively, get control of an asset, put, all those, bargaining chips on the table to get money back faster, have only gotten better, since 2005 to 2015 with the advent of NCLT, IBC, and an increased sort of focus, whether it's real estate, where I don't think anywhere in the world, correct me if I'm wrong, Ashish, homeowners actually have a seat on a creditor table, right? I don't think anywhere else.
Right.
India is super unique, right? So from that perspective, there is massive disincentive for developers to, sort of divert money and so on and so forth, which used to happen quite a lot, before the advent of RERA and so on and so forth. So that's corporatized that particular sector quite a bit. But even on the non-real estate side, I think the teeth that, things like NCLT, increased, vigilance, cross checks and balances across various jurisdictions, I think have generally, made, and the advent of social media, reputation to lose, there is significant amount of stuff, even from a promoter diligence that's built into our credit policy, right? So you do essentially in every credit investment, 3 kinds of diligence. One at a promoter, one as a project and its viability, and the other is, what is your downside and when you're going to get money back, right? I mean, so essentially all of us do a sort of merger of all of these risk elements, and, whether it's with in-house research teams or analyst teams or in addition with the benefit of third-party due diligence, every single deal goes through the scrutiny, before capital is deployed. So I would second Ashish's view that a nice way to play it, this whole sector and asset class would be through funds and through, structures like what Certus is offering. Simply because, you are dealing and you're entrusting money to people who've done this before, with a track record, with over a period of time across difficult vintages. Just to give you an example, we raised our first fund, talking about real estate in 2017, when I first went and pitched to a high net worth. They simply couldn't understand. And I think even today, what is the difference between real estate and credit? So real estate was viewed as one sort of, ambiguous or, everything thrown into it pot, where it has a certain set of risks. And will you make 20 to 22%? Nobody would care about what strategy, but there are so many nuances. For example, we don't enter anything before pre-approvals. Everything is a brownfield project entry, and every single deal is supported by multiple enterprise cash flows and so on and so forth. So there are varying, I think, styles in terms of risks you can take. You can go very early, you can go, into a distress space, you can go into performing credit, even within that, there are nuances. So I think investors, especially discerning ones in terms of ultra high net worths, family offices, insurance companies, even some bank treasuries, they're all, fairly getting educated in terms of, what capabilities and styles and personalities and nuances each of the managers, are specialized in and what they do. And so they're in a reasonable position, to, make those calls and increasingly allocate from their portfolios. So, this is in a summary and for a layman, what it involves. As I said right up front, you're still looking at returns at a gross level between 15 and 18%, So, when you look at annual returns, over a span of a long period of time from public markets, they have tended to range in that bucket. So, if you're actually getting a senior secured, downside protected, diversified portfolio with a manager who's experienced in delivering it to you consistently, it becomes a pretty attractive asset class to ignore. And so hence we are seeing more and more allocations towards this asset class.
Right. Okay, Hemant. So Karthik talked about different nuances, and you all have spoken about different kinds of private credit funds. But if you can simplify for our viewers, different kinds of credit funds by definition, what they mean, and which ones are fairly safer, riskier, riskiest. So all these aspects. Who should go for which ones?
So this is a very nuanced question, Aparajita. I think one thing I want to add to Karthik before I come to this question I think in the business of credit, what is important is ability to pay. Ability to pay is governed by cash flow collateral. So one should have the ability and the borrower should also have the willingness. And willingness is judged through counterparty diligence. At Neo, we firmly believe that counterparty diligence, whom you are giving money to, is a very, very important question to be answered. And that is done through multiple diligences that the borrower goes through. Okay, so typically our framework is about cash flow, collateral, and counterparty being the most important. Now, coming to your specific question on the type of funds that are there in this space, I think in the last 10 years of at least my professional experience of managing more than 40,000 crores of alternative assets, there are multiple funds available, okay? There are simple core credit solutions, very, very bankable, as Karthik was explaining. Typically, your principal repayments and your interest repayments keep coming on time on a quarterly basis, cash flow back largely. Typically, those funds can aim to deliver anywhere between 13 to 15% returns. Maybe a new entrant in this space should opt for such funds, at least get a taste of the space. Large structural opportunity. Effectively, some part of bank lending is getting replaced by alternative asset managers. And this is a phenomena we are seeing globally. It's a phenomena not happening in India alone. Globally, this is called direct lending. In India, this is called AIF in that sense. So 13 to 15% simple cash flow back strategies. Then there is the entire space of 16 to 18% strategies where you are lending to corporates, cash flow back, you are lending for a growth opportunity. So typically the returns can either be only coupons or it can be a mix of coupon plus a little bit of equity play, but eventually the customer can end making close to 16 to 18% returns. Pre-expenses, pre-taxes, but these are essentially a substitute for growth capital. As Ashish had explained, a company does not want to dilute, but wants to raise a bridge financing as bridge financing to a liquidity event. It would come to people like us. So 16 to 18% is the second genre, which is essentially more growth financing, more a substitution of equity capital in the form of credit. Okay. The third part I would call is more real estate credit, where effectively, as Karthik said, after all approvals, typically people do this after all approvals, because that is where the risk reward, tilts in favor of the lender. You get all approvals, you're effectively giving a bridge finance as a last mile financing solution. Typically, it's more 18 to 20%. I think if you look at what Ashish is also doing, it's more the 18 to 20% last mile funding solutions that customers can access. And then there are special credit funds, which we have specialized in for the last 10 years, and which is our first offering at Neo, which is essentially capitalizing on some special situations where borrowers cannot get access to bank funding, either because of some regulatory reasons or because of asset liability mismatch of banks, or banks cannot structure some deals. And those are typically called special credit opportunities. Then there is an inherent edge when you do a certain transaction, when you do an investment, and that is the bucket of 18 to 22% returns. But across all strategies, Aparajita, whether it is the 13 to 15 zone, 16 to 18, 18 to 20, 18 to 22, I think the common feature that an investor should leave this call with is these are strategies backed by cash flows, backed by collateral, and every quarter or at a certain frequency, there is a certain amount of cash flow which keeps coming back to investors. And that is the beauty. These are regular income throwing strategies. For example, in our fund itself, out of 100 rupees that a customer invests, in 3 years, typically he would get back close to 65 to 70 rupees back. That is the frequency of the cash flows that go back to customers. Every quarter, one can expect close to 6 to 8 rupees back every quarter. So cash flow, regular income with safety and good pre-tax returns is what a customer can expect across the spectrum in private credit.
So they see consistent performance because they keep receiving cash flows.
Absolutely.
All right. So Ashish, I understand that AI space is not as well regulated as mutual funds are. So what are some regulations that govern this space? What should investors know about it, their rights?
So, I think there is a fair bit of regulation that is coming on to AIF. In fact, I think
Very
it's starting to get to a point where it is going to become over-regulated, to be honest. But I think the way SEBI has originally approached is that the minimum investment requirement in an AIF fund is a commitment of at least 1 crore. And the very reason of doing that was basically, okay, these are a lot more illiquid kind of strategies. They don't have a daily NAV like most of your mutual funds have, whether debt or equity. You can't just get in and get out at any point in time. So you really want a bit more evolved and sophisticated to be participating in AIFs, right? To be very honest, regulation aside, I mean, that is true for anything and everything. Even if it is a mutual fund investor, you've got to be thoughtful as to who you are investing, what is the fund manager, what is the strategy, and all that. But it becomes even more so important when you talk about AIF, because what happens is that on AIFs and all that stuff, yes, it takes a longer period of time for you to know if something is not working well. And it is far more difficult to get in and get out. So I would always recommend that more than anything else, I think investors should certainly look at two things. What is the track record of the that fund manager and the underlying team around it, and what's their alignment? I mean, generally speaking, most funds do invest a little bit of their own balance sheet corpus in that. A lot of teams are invested in there, etc. And all of that brings us a certain amount of alignment. So I think those kind of things are certainly there. Where SEBI is focused from a regulatory point of view is they want to kind of level the playing field. They don't want AIF to do, differential class structures in terms of payoffs, right? I mean, differential class is okay in terms of fees and all that stuff, depending on if you're a very big investor versus a small investor, right? They're, I think, trying to very tightly regulate what you can do as co-investments, because large investors in AIF typically want to double up on interesting transactions. That's honestly a global phenomenon. The largest of pension funds and sovereign wealth funds and multi-billion-dollar have those co-invest rights. And that has been the case in the Indian market as well. I think SEBI is trying to kind of regulate that to a certain extent. I think SEBI is trying to make it more transparent. They're trying to think around things about further increasing this 1 crore. They're also thinking about bringing some more discipline to the distribution of these funds, as they did in the mutual fund industry several years ago, and it has over a period of time helped mature it even further. So I think those are the things I would say investors should kind of keep at the back of their mind.
Okay, Karthik, now to sum up, if you can tell our viewers that which are some ongoing credit funds that you have at your firm or upcoming funds, something on these lines?
But just speaking for ourselves as Sundaram Ultimates, we have our corporate credit fund, which is the fourth of the private credit funds which are open for investment. We intend to close this fund in June, so there's plenty of time for people who are interested, to write into us and subscribe to that fund. We've already raised half of the capital that we intend to raise, we'll do another close by March and a final close by June. So that's open. We also intend to launch the next series of our real estate in the first quarter of next fiscal. So that's already filed with SEBI, and as soon as that is approved, we'll be in the market with that. We also, of course, those are two immediate things over the next 3 to 6 months, one open and one likely to open. And our future strategies will also revolve around this, in addition to which we intend to do something in the impact space. So that is likely to come out as well.
Okay, the same question for Hemant.
So, Aparajita, I think the team at Neo is a team that has managed, credit assets of more than 1 lakh crores in India in the last decade. I think that is the overall experience that the team at Neo gets. We launched our first fund at Neo when we started a new company, and it's been a 6-month journey. We have now raised approximately 900 crores, as I said. This is called Neo Special Credit Opportunities Fund. It is a unique debt strategy, throws regular cash flows, focuses on EBITDA positive companies. And this is a fund that we expect to close sometime in June of this year. I think overall at Neo, we want to be specialists in, delivering better regular income, fixed income, credit returns to our clients in the long run. And as new asset management, we want to be champions in this space. We want to specialize in this space. In fact, I keep telling clients whenever we meet them, think of anything that has a cash flow, high quality cash flow, anything. Today, it's companies where you're giving credit, where you're making EBITDA, they are paying you interest. Tomorrow, it can be high quality assets, whether it is data centers, warehouses. Tomorrow, it can be simple bankable loans. Anything that has cash flow is our area of focus going forward, which we want to annuitize and give as returns to our clients. And that is how big the opportunity overall in credit is. So we are currently live with the Neo Special Credit Opportunities Fund. It is a 2,000 crore fund, probably one of the largest maiden fund targets in India. And we are halfway done. So hopefully by June, July of this year, we should be full way done on that.
Okay, Ashish, which are the funds at your firm that people should be aware?
So I think we have taken a very different approach, Aparajit, on this whole thing. I mean, so as a team, so we focus on real estate. So we do a lot of real estate senior secured credit funds. That's what credit ideas and structures. That's what we do. So as a team, I think the searchers and earnest team that come from global financial institutions, which are top names in real estate globally, that includes Morgan Stanley, KKR, and Indian firms like Kotak, Piramal, and all that stuff. So as a team, we would have done more than $3 billion of investing and lending in real estate in India across these various things. So over the last few years, we have, after starting Service Capital, we have done about 8,000 crores for various global financial institutions as part of their extended team. And then we have basically brought similar opportunities, but we are taking a slightly different route right now, wherein we create these opportunities. They typically offer 15 to 16% senior secured credit. They typically pay that return on a monthly or a quarterly basis. Typically, the life cycle of these deals is anywhere between 2.5 to 3.5 years, right? And our investors can totally see exactly what that transaction is about, who that money has been given to, which city it is in, what is the status of that project, when is that money going to come back. So these are, and all of this is very tech enabled. So it is on our platform called earnest.me, which is earnest with a double N.me. And basically the entire transaction can be closed on through one OTP. So it's very, and then the investors can track the performance of those investments and those underlying projects on the entire portal. So I think we are contemplating, we have taken the AIF license very recently. We are contemplating launching a fund, but most of the distributors and investment advisors that are working with us, they are encouraging us very strongly to continue with this format, because I think their clients are just loving it, because they can see exactly what they're investing into, and they can choose to diversify. If they are more interested in Pune versus Chennai, they can do more of our Pune deals versus Chennai deals, and so on and so forth. So we have to still decide whether we'll launch an AIF, but we're certainly going to do 500-600 crores of this format in this financial year on the Earnest platform.
Okay, that's awesome to know. Okay, so thank you so much, Karthik and Hemant and Ashish, for taking out time and being part of it. And now addressing to viewers. So private credit funds, these are really less understood and fairly new space. I believe this session has offered some key insights about this space, and I would request you all to give it a shot. Now over to you, Ritika. Thank you so much.
Well, thank you so much. I think we have had some very good and power-packed sessions. There was a lot of knowledge and a lot of things that we learned today.